for 4 minutes.
Thank you, Mr. Chairman. And I'd also like to thank you publicly for our gentle persons agreement, our handshake agreement that we arrived at on the floor yesterday. Thank you again. I also, Mr. Chairman, thank the witnesses as you have, and I thank the staff for providing the intelligence that I will share today. Today's hearing is but another assault on helpful investor protection, climate change-related regulations. Friends, the science on climate change is clear, perspicuously so. It's not a question of whether it's going to happen, because it's already happening. For many public companies, extreme weather events or even slight changes in regional weather patterns can affect their operating performance. Recently, Coca-Cola was forced to close one of its bottling plants due to the overuse and extraction of groundwater. This shutdown resulted in an unexpected loss of profit and delayed manufacturing timelines. Some companies already include general disclosures about climate risk, but those disclosures are typically very vague, lack standardization, and do not provide investors with a good sense of the scale of the risk the company faces from climate change. The Securities and Exchange Commission, SEC, recently proposed rule on climate seeks to address this vagueness and lack of standardization, as well as provide clear guidance for publicly traded companies on climate-related disclosures. In a recent survey, more than 80% of U.S. investors indicated that companies need to more openly communicate the risks around climate-related factors, and 73% also said they are more likely to invest in a company that shares with investors its plans for effectively managing those factors. In response to increased investor demand for this type of information, in March of 2021, the SEC released a proposed rule to require public companies to make a variety of quantitative and qualitative disclosures regarding climate-related risks that are likely to have a material impact on their business. My colleagues from across the aisle are finding fault with the SEC's proposed rule, but offer no constructive solutions of their own. Those of you paying attention will very soon realize that this is a regular, recurrent, rhythmic part of the Republican playbook. Republicans opposed the Dodd-Frank financial crisis legislation, but offered no serious alternative legislation after the last financial crisis. Republicans continued to oppose the Consumer Financial Protection Bureau, but offered no alternative approach to protecting everyday consumers. Perhaps most notably, Republicans vehemently opposed Obamacare. The name may have had something to do with it, but the Republicans vehemently opposed the Affordable Care Act, but could provide no alternative even when in a position to repeal and replace it. Today's hearing is straight out of the Republican fictitious repeal and replace, the sky is falling playbook. Friends, the sky is not falling, and there is no need to repeal and replace. I yield back the balance of my time.
The gentleman yields back.